Welcome back to the Deep Dive. It is Monday, February 2nd, 2026. We need to talk about a ticker that did something very weird last week. And when I say weird, I mean took a massive jump that honestly, on the surface, makes absolutely no sense.
It definitely caught the market off guard. I mean, usually when you see a double-digit pop overnight, it's some flashy biotech firm or, a new AI darling.
Right, but we are not talking about a startup. We're talking about Deluxe Corporation, ticker DLX. And I have to be the skeptic here right out of the gate. When I hear Deluxe, I think of that little blue box of paper checks that shows up in my mailbox maybe once every 5 years. It just feels like a relic.
That's exactly the reputation they've been fighting for a decade. It's the definition of a legacy brand.
So explain this to me. They report their Q4 and full year 2025 earnings, and suddenly the stock vaults over 13% in a single trading session.
Yeah.
From $23.90 to over $27 on double the volume. Did everyone suddenly decide to start writing checks again?
No. Check usage is still declining. If that was the bet, the stock would be zero. The market didn't buy the stock because of checks. They bought it because they finally believe that Deluxe isn't a check company anymore, or at least they're dangerously close to not being one.
We've heard the pivot story from legacy companies 1,000 times. IBM, Xerox, every dinosaur says they're doing data now. Is this actually sticking, or did they just have one lucky quarter where they, sold off some assets?
It wasn't asset sales. This was a clean operational beat. And to understand why the market panicked, in a good way, you have to look at the expectations versus reality. The street was expecting non-GAAP earnings per share of 83 cents? Just a steady, boring quarter.
And what did they deliver?
96 cents.
Wow.
They smashed the bottom line estimate by 13 cents. Revenue was $535 million, which was nearly $20 million over what people were expecting. That's a 2.8% growth year over year.
Okay, but 3% growth doesn't exactly sound like a rocket ship.
For a company that everyone assumes is a melting ice cube, positive growth is massive. It signals that the new stuff is finally growing faster than the old stuff is dying.
Okay, let's dig into that new stuff. Because if I'm an investor, I'm looking at this and thinking, great quarter, but eventually paper checks go to zero. What exactly are they selling that's making up the difference?
This is the core of the thesis. It's what I call the crossover point. In the report, management highlighted that payments and data now account for 47% of total revenue.
47%. So nearly half the company is tech.
Exactly. And that's up from 43% a year ago and way, way up from about 30% back in 2021. Management explicitly stated that later this year, in 2026, they expect to reach parity.
Parity.
Which means for the first time in their 110-year history, tech revenue will equal print revenue.
Why does that 50-50 split matter so much, though? Is it just a psychological milestone? Or?
It's about how the algorithms price the stock. Think about it. If you're a commercial printer, the market gives you a very low multiple, maybe 5 or 6 times earnings, because your future looks bleak.
Right.
But if you're a data and fintech company, you get 12, 15, maybe 20 times earnings.
So as long as they're 51% printer, they get treated like a printer.
Precisely. But once they cross that line and 51% of the revenue is coming from high-margin data services, the market has to reclassify them. That 13% jump we saw, that's the market front-running the reclassification.
Hold on, though. I want to push back on the data side of things. It's easy to throw around buzzwords like data solutions and AI. What is their actual moat? If I'm a bank, why am I buying data from a check printer instead of, say, Salesforce or HubSpot?
That is the right question. And the answer lies in their history. Because they've been printing checks for a century, they have a proprietary data lake that virtually no one else has. They have a map of economic relationships. Think about what a check is. It's a signal of a transaction between two entities. Deluxe has decades of data on small businesses, who they pay, when they paid, who they bank with. That isn't just a list of names and emails you can scrape off LinkedIn. This is verified financial behavior.
So they know that Bob's Plumbing buys supplies from Acme Corp every Tuesday.
Exactly. And they're feeding that historical transaction data into their generative AI models. So now they go to a bank and say, we can predict which small businesses are about to need a loan or which merchants are looking to switch payment processors based on actual cash flow patterns we've seen for 50 years.
That's a lot more potent than just, hey, hey, here's a list of leads.
Right, and the numbers back it up. The data solutions segment grew revenue by 31.3% in 2025. That is hyper-growth territory.
31% is significant. But you mentioned they're using AI to run marketing campaigns.
Yes, they're using Gen AI to scale that insight. So instead of a human analyst saying, hey, target these 10 plumbers, the AI can run thousands of micro-campaigns simultaneously for their bank clients. It's offering a level of efficiency that the banks really can't build in-house.
So they aren't just selling data, they're selling the execution of that data.
Correct. And that segment is what's driving the excitement. But, and there's always a but, this kind of growth creates its own problems.
Let me guess. The law of large numbers.
In a way. Management issued a warning about monster comps for the second half of 2026.
Explain that for the listeners who might not stare at earnings sheets all day. What is a monster comp?
Okay, imagine you're a high jumper. In 2025, you suddenly jump 7 feet. It's amazing, everyone cheers. But now, for 2026, the bar is set at 7 feet just to break even. If you jump 6'10", you technically failed compared to last year, even though it's still an incredible jump.
So because the data segment exploded in late 2025, the year-over-year growth numbers in late 2026 are going to look significantly smaller.
Exactly. They might drop from 30% growth to maybe 10 or 12%. Management is trying to warn investors now, don't freak out when the percentage drops. The business is still healthy.
It's a good problem to have, assuming the underlying demand is actually there. But we have to talk about the anchor, the print business.
Yeah.
You said it's still half the revenue. If check usage is dropping, isn't that just dragging down the whole ship?
It is a drag on the top line, sure. Print revenue fell 5.7% in 2025.
That seems pretty steep.
It is, but here's the counterintuitive part. Deluxe doesn't necessarily want that revenue back.
They don't want revenue.
Not if it's empty calories. They're actively firing bad customers. They're walking away from promotional work, printing flyers and business cards where the margins are razor thin. They're focusing purely on the core check printing where they have pricing power.
Because if I need checks, I need checks. I'm not going to shop around to save 50 cents.
Exactly. And the result is that the adjusted EBITDA margin for the print business is sitting at 32.3%.
32%. That's software-level margins on paper products.
It is incredibly profitable. Think of the print business not as a growth engine, but as the bank. It is the venture capitalist funding the data startup. As long as they manage the decline, keeping it slow and profitable, that cash flow pays for the AI development, the debt reduction, and the dividends.
So the strategy is, let the print business slowly melt, but catch all the water and use it to water the data plant.
That is the perfect analogy. And as long as the data plant grows faster than the ice melts, you have a winning stock.
This brings us to the boring but sexy part of the earnings call, the balance sheet. I know people usually tune out when we talk about debt leverage ratios, but in this case, it feels crucial to the thesis.
It's the most critical piece of the puzzle for risk. Deluxe has been carrying a fair amount of debt from previous acquisitions. In a high interest rate world, that debt is expensive.
It's like carrying a balance on a high interest credit card.
Yeah.
It eats up all your free cash.
Exactly. But in 2025, they reduced their net debt by $76.2 million. They hit their deleveraging targets a full year ahead of schedule.
And what's the leverage ratio now?
It dropped to 3.2 times. And their goal is to get below 3 times in the first half of 2026.
Why is that specific number 3x so important? Is it just an arbitrary banker rule?
It's a threshold that changes the rules of the game. When you're leveraged above 3 or 4 times, you're in the risky bucket. Lenders charge you more. You're restricted on what you can do.
You're in the subprime category.
Essentially. But when you cross below 3x, you start looking like investment grade. Your cost of capital drops. Suddenly you have the flexibility to maybe acquire a smaller tech competitor or buy back more stock. It completely changes your offense.
So they are paying down the mortgage so they can afford to renovate the house.
And they're doing it with cash flow. They generated $175 million in free cash flow in 2025. And for 2026, they are guiding for $200 million.
$200 million in free cash flow for a company of this size is nothing to sneeze at.
It's a yield of over 10% relative to their market cap. That provides a massive floor under the stock price.
Let's look at the guidance for 2026. They're projecting revenue between $2.1 and $2.17 billion and adjusted EPS up to $4.30. Is that realistic, given the macro headwinds? We keep hearing about tariffs, inflation, labor shortages?
Management addressed that. They noted that consumer behavior has stabilized.
Stabilized. That's a carefully chosen word.
It is. It's code for we aren't seeing a recession yet. They admitted the macro risks are there. Tariffs on paper or ink could hurt margins, but they feel the efficiency gains in the data segment will outweigh those costs.
So if I'm listening to this, I'm hearing a story about a company that is successfully pulling off a magic trick. But I have to ask, what breaks the thesis? What's the red flag that makes this 13% gain disappear?
The economy is the biggest risk. If small businesses stop opening, or if existing businesses stop marketing, the data segment hits a wall. Remember, that data is based on transaction flows. If transactions slow down, the value of the data drops.
And since they are betting the farm on that segment, becoming the majority revenue source, a slowdown there leaves them just being a check printer again.
A check printer with a lot of expensive tech that nobody is buying, that's the bear case.
But right now, the market is voting with its wallet that the bull case is winning.
The execution is undeniable. They said they'd pay down debt. They did. They said data would grow. It exploded. Credibility is a currency, and right now, Deluxe is rich in it.
It's a fascinating setup.
Yeah.
You have the safety of the cash cow combined with the upside of the tech pivot, which actually leads us perfectly into how an investor might actually do something with this information.
Right.
Because simply buying the stock is one way to play it, but that exposes you to the general market ups and downs.
Yeah.
If the whole S&P 500 tanks, Deluxe probably goes with it.
Yeah.
So we need to be a little more creative.
You do.
That brings us to our This Is Not Financial Advice segment. Please remember, we are just two voices in your headphones. We are not your financial advisors. Do not bet your retirement, your rent money, or your kids' college fund on anything we say here. This is for entertainment and what-if scenarios only.
Seriously, do your own homework.
Okay, so if you accept the premise that the market is treating a fintech company like a paper mill, how do you actually express that view in a portfolio while stripping out the noise?
I've been thinking about this. I call this trade the crossover straddle.
I like the name. How does it work?
The core idea is that you want to bet on the divergence. You believe Deluxe is leaving the industrial sector and joining the tech sector. So, step one, you go long on Deluxe.
Okay, that captures the re-rating. If they hit that 50-50 revenue split, the multiple expands and the stock goes up.
Right, but what if the economy rolls over? What if paper prices skyrocket? That hurts Deluxe. So, step two, you hedge. You short a pure-play legacy printing company.
Someone who doesn't have the data business.
Exactly. Find a competitor that is just paper, just commercial printing. No AI, no payments rail.
I see the logic. You are creating a pair trade.
If the industrial economy slows down, the pure play printer gets hammered. Your short position makes money, which offsets any dip in Deluxe.
And if the economy booms?
The pure play printer might go up a little, but Deluxe, because of that tech multiple, should skyrocket. You're betting on the spread between old school and new school.
You're effectively betting that Deluxe is the one boat in the harbor that installed a motor while everyone else is still rowing.
That is the perfect way to put it. You aren't betting on the ocean, you're betting on the boat.
It's a clever structure.
Yeah?
Again, completely hypothetical. Don't blame us if you lose your shirt. But it really highlights the unique position this company is in.
It does. It's rare to find a company that is essentially mislabeled by the market.
So, to wrap this up, Deluxe Corporation. Q4 earnings beat. Revenue mix shifting rapidly toward data, debt coming down, and a market that is finally waking up to the fact that they do more than print those little blue boxes.
You know, the most dangerous thing in the market is a boring company that suddenly figures out how to be exciting. Investors usually ignore them until the transformation is already priced in.
And with a PE ratio that is still well below the tech sector average, it seems like it might not be fully priced in yet.
Not if they execute on 2026. Watch that 3x leverage line. When they cross that, things could get very interesting.
We will be watching. Thanks for diving deep with us today.
Always a pleasure.
Keep your eyes on the tape.